Oliver, Standard Chartered, the emerging markets-focused UK bank, has come out fighting today on its capital position, despite some doubts by investors. So the question is, can it maintain earnings growth faster than its growth in risk-weighted assets?
Well, Standard Chartered, I think, has been shaken by lots of things over the past year or so. Its shares have fallen heavily. This is a bank that was the sort of darling of bank investors since the crisis because of its emerging market exposure. It's had a bad year. Emerging markets aren't growing as much as they were. Its share price has fallen. And there have been questions around its capital about whether it has enough capital. And it's been at great pains today to say, yes, absolutely we have enough capital, and to demonstrate that its common equity tier 1 ratio under the Basel III rules is 11.2%. Now, most other Europe-based peers are at sort of between 10 and 11. So it's very keen to point out that it's very comfortable on its capital and well above where the regulators require it to be. But the big question for Standard Chartered is not so much where it is now, but how much capital it's got to fund further growth. And this is kind of where the question is around in the company at the moment.
Okay, now looking at this from the perspective of an investor, and as a bank investor, I probably don't want a capital ratio below 10%. That's probably my new baseline here. But do we like an emerging market bank which goes to slower earnings growth but still maintains a healthy capital position? Or do we want one which actually goes out, grabs market share, but maybe has to do a rights issue to fund that?
Well, Standard Chartered is going very much for the first of those two scenarios. It had previously promised double-digit earnings growth. It's now promising high single-digit. And as you mentioned earlier, it's promising that its earnings will grow faster than its risk-weighted assets. So slightly slower growth, but growth that can be funded from its earnings without any need for external capital. I think investors will be very nervous of a bank that said, given the emerging markets background at the moment, we're going all out for growth, we're going to add lots of risk-weighted assets, we're going to make lots of new loans, and we need a rights issue to do that. I can't see a lot of investors backing that, but still, it's not quite the exciting growth prospect that Standard Chartered used to be, which perhaps is why the share price has fallen so much over the past year.
Okay, and I mean, one particular problem which investors have highlighted is StanChart's issues in Korea, which is a tough market. What did they say there today?
So they've said that they're still committed to the Korean market, although they've taken a $1 billion write-down on the business there. Korea is very difficult. Return on equity across the industry is about 3%, so a really tough place to be a bank. And you might say, looking at it from the exterior, why not get out of Korea? What's the point? It's awful returns. But the two questions around that. Firstly, is there anyone who would want to buy a bank in Korea? Certainly no one who's not in the market already, possibly a local rival. And the other thing is that Standard Chartered sells itself on being an emerging markets-focused bank, enabling companies in these markets to trade between each other and helping trade flows. It will be hard to do that without any sort of presence in Korea. It will be a big hole in its portfolio if it were to get out of Korea altogether. So I think for the moment, the bank's just going to grin and bear it in Korea.
Okay, how do you solve a problem like Korea? StanChart's going to have to find out. Thank you, Oliver.